Hi everyone, today we are going to discuss Q3 FY19 performance of Indostar Capital Finance. Indostar Capital Finance, which is a retail asset financing company, reported mixed set of numbers in Q3. Its net profit increased by 81% on a year-on-year basis. Though disbursements declined and margins compressed, the profit growth was mainly aided by decline in credit cost and improvement in cost-to-income ratio. In a separate release, the company announced acquisition of commercial vehicle finance business of IIFL. The acquisition is of almost 3,900 crore portfolio of IIFL CV financing book. This strategy or this acquisition is in line with management's focus to increase the non-corporate book. So now let's look at the key positives from the Q3 performance. Incremental disbursements of Indostar Capital Finance is driven by retail assets, which is a key positive for the company. Though the asset book remained almost flat on a sequential basis, retail assets grew by 13% on a QOQ basis. The primarily wholesale financer, Indostar had forayed into housing, vehicle and SME financing to de-risk its loan portfolio. The result of its diversification strategy is clearly visible in the changing asset mix. Non-corporate loans now constitute around 42% of the total loan book as compared to 24% a year ago. 68% of the disbursements in the current quarter was towards retail assets. Indostar Capital Finance's asset quality is another strong area because its gross NPA is below 1% and it has been resilient so far. Having said that, the lender's real estate exposure is at around 32% of the loan book, which is we think is slightly vulnerable considering the current environment. The lender reported significant improvement in operating efficiency with cost to income declining to 33% as compared to 38% a year ago. And thanks to that, it reported a very healthy earnings profile with return on asset of around 3.2%. We think the return profile will be under pressure primarily because of the diversification strategy. However, the move is desirable because it will de-risk the loan portfolio in the longer run. And thanks to the IPO last year, wherein the company had raised around 700 crore of capital, it enjoys a very strong capital position with capital adequacy ratio of around 30%. This gives it an edge over peer group in terms of raising funds. However, it is currently depressing its return on equity to below 10%. So apart from these positives, what was the key negative from Indostar's Q3 performance? It was the significant compression in margins. Net interest margins compressed by almost 80 basis points on a sequential basis to 7.7%. And this was mainly because of increase in cost of funds following the liquidity crunch, and also because the yields compressed because the company has entered into the low margin segments like housing finance. So what's the outlook on the stock? Indostar stock witnessed a steep decline since September following the liquidity concerns that engulfed the NBFC sector. As such, the valuations have turned extremely compelling and attractive. The risk-reward ratio is favorable with the stock currently trading at below 1x FY20 book value. In fact, its current market capitalization is also less than its Q3 FY19 net worth. The limited history of the company and also the sectoral concerns have made investors jittery. However, we think that the valuations are very compelling and its pricing in the most concerns, making Indostar a worthwhile long-term bet. That's it from our side. For more news and update, log on to moneycontrol.com.